Hey there, listeners, and welcome to the Dairy Monday Market Watch. This podcast is put on by Cornell Cooperative Extension's North Country Regional Ag team. I'll be your host. My name is Kelsey O'Shea, and I'm the Farm Business Management Specialist here in Northern New York. Each week, we're going to talk with a market specialist about what's happened over the past week, what's coming up ahead, and how these events may impact your business. So be sure to stay tuned and check back with us each Monday. If you're not already, make sure you follow our YouTube channel. We are CCE North Country Regional Ag Team, or follow us on Facebook to see these updates. This week, our market specialist will be Anup Singh.
Thank you. Thank you for having me. So my background is, my name is Anup. I am married into dairy. I met my beautiful wife in Houston, where I was working in the energy business. So was she. And her parents are dairy farmers in Vermont.
Thank you so much, Anup, for joining us again this week. Just as a quick recap, last time we talked about when markets were limiting down and we were seeing very low bottom prices for various dairy products. And this time we have a little different agenda. What people are really curious about right now, because we're past sort of the initial shock, we're really in it, we've kind of got our routines going, and all this is more so from a milk and dairy products standpoint and price standpoint. How does it end? What do we look like 24 months from now? Or what do you expect us to look like from a market standpoint? You know, and this is obviously all based on your best estimates, and there's a lot of moving pieces that could go into that. But what people are looking for, I think, is some sort of estimation of how it ends, and then basically the steps that we, like you talked about, once we kind of have that estimate of how it ends, we can take steps accordingly to get to that point. So that is the focus for today.
Perfect. Is that all of us like to jump to what the answer is, right? What the answer is, what this person who coached me through thinking about this in markets is, he said, well, think about how this will play out, right? In order to get to that end point, what has to get solved in the way? Right. And then you will learn how to look for clues early on, right? So the way milk pricing works, which the milk community, dairy community is very well aware of, is the price of milk is derived from the price of commodity. So cheese plus whey plus butter makes class 3, butter plus non-fat makes class 4, and various combinations of 3 and 4 inform 2 and 1. So really what is driving the price of milk is the price of the commodity. What's driving the price of the commodity is the processing capacity available to process milk into that commodity, and then the demand of that commodity. So milk supply matters materially to the extent that the capacity, meaning the plant's installed capacity, is either being met or not met by the supply of fluid milk. So what I mean by that is, I would not be surprised if we were to go back in history and we find that milk was being dumped when cheese was $1.80 in the past. Why? Because in certain markets, if there was surplus milk defined by milk in excess of locally meaning within the region, available processing capacity, then you have surplus milk. So that surplus milk could exist even in the most well-supplied market or the most undersupplied market, because of the configuration of where the cow shed is, the milk shed is, and the arrangement of where the plants are currently located. And what is expensive is to ship milk or transport milk from one region to the other. Essentially, you are transporting water, right? So the decisions of utilizing milk or not utilizing milk, I hate to use the word dumping, but that's how it manifests itself, is a decision that's based on, is capacity available? What's the cost to transport the raw material, which is fluid milk, to that capacity? And is that worth doing it given the price of the commodity, right? So let's say if it takes us $5 to ship milk from upstate New York to Pennsylvania per hundredweight. Let's just say that's what I don't know what it costs, but let's say that's what it costs. $5 to ship it, which means by the time the milk gets there, so we in upstate New York have to accept $5 below class,
Okay.
right? So which means in today's prices is $15, and so we will have to accept a $10 milk price here, which I think is great. It's better than zero, right? Now, if the milk gets there and the plant is not available to process it because the plant is already full with local milk, and let's say then it takes us $10 to move the milk from here to Wisconsin. So in other words, would you ship it? Because the cheese price is $1.20.
Okay.
Right? So it costs you $10 to ship it. The cheese is, by the time you convert cheese to milk, it's $11. Maybe it's not worthwhile to ship it.
Right.
Right? So that's how some of those decisions, get made today. And they will get made in future as well. Certain economies in the world, New Zealand being one of them, their plant capacity is planned for peak milk. So in other words, every ounce of milk that's produced gets converted into a commodity. But of course, then there are parts of the year when the capacity is utilized zero. So now building capacity that much is very expensive, and the farmers pay for it because that's the capital you have to go get financed, right? For building a huge plant. So those are some considerations in how supply and demand and what are the choke points in that supply and demand value chain. So the price of commodity that drives the price of milk is the price of wholesale commodity. So cheese block.
Yep.
Cheese
Okay.
then will go into a cut and wrap plant, and the cut and wrap plant, they will slice the cheese block into various formats in which then it'll be sent to the grocery store for people like us to consume at the grocery store.
Right.
So you take a 640-pound cheese block, slice it into 8-ounce bars, or you take the block, you shred it, or you take the block and make other formats to it. It's the price of the block that's driving the price of the commodity.
Right.
Wholesale. Now, of course, the demand at the grocery store influences what is the price of the block. So if the demand in the grocery store for certain products is very high, the processor in the middle has to come and buy blocks. And if the demand in the grocery store is higher than what was previously anticipated, that processor is willing to pay a higher price for the block. Higher price for the block, higher price for class 3 cheese, class 3 milk.
Yep.
So the other part also is, so conceptually, the farmer or the farm community could produce more milk. But if the number of tons of milk going through a plant does not change, meaning no new plant capacity gets added, the cheese price will still go up because we are eating more cheese and there are not enough cheese plants. And then class 3 price will go up while the farm community could be dumping milk. That is a very real outcome. So now we get into take everything I just said, and now let's construct our argument for the next 12 to 18 months. So next 12 to 18 months, what we discussed last time is that I feel that the demand for cheese broadly should be unaffected in the near term. Because most of the cheese that we consume is not in the restaurants. We consume more cheese in food at home than food away from home. We consume a lot of butterfat in food away from home.
Mm-hmm.
The cheese consumption, most of it is food at home or food at home in other forms. So as we were saying last week, 30 to 35%, a third of cheese that's produced is sold as cheese in grocery stores. Another 15, 20, 30% is cheese that is sold in grocery stores and other foods, so on pizza or on packaged food. 70, 80% of mozzarella that's produced gets sold on pizza. Pizza is a takeout deliver home kind of food. So what that leaves us then is cheese slices that went on burgers in places like McDonald's and Burger King and similar formats. And those outlets do have, lower sales expectations with the shelter in place and things like that. So I think cheese takes a, but off between cheese and butter fat, I think cheese has a much brighter future in the near and the midterm than what I think butterfat has in the near term. Now, having said that, when consumers lose jobs or their incomes are impacted, they buy cheaper food because really, of all the categories in which money is spent, housing, if I have a mortgage or I have a rent, I can't really go reduce it. I could go defer my payment on the rent or defer my payment on the mortgage, but I can't really reduce what I pay. I can't reduce healthcare. If I have a job and I'm lucky enough to have a job, I will still drive the number of miles I have to drive to get to that place. Yes, gas is cheaper, so that reduces my spend on gas. But really, money you spend on gas, money you spend on housing, money you spend on healthcare, money you spend on insurance, whether we like it or we don't, it's a tax. We have to pay it. We will pay it. There's some
Right.
discretion to it, but we will pay. So where do we then take money away from? Well, we take money away from discretionary spending. So we will not buy clothes, we'll not buy shoes, we'll not buy this, we'll not buy that. And by buying cheaper food. So buying cheaper food, we'll still buy the same quantity of food, we'll just buy cheaper foods. So what that's then telling us from a cheese story then is in the grocery store, the cheapest form of cheese you can buy, format, not, you know, any other reference, but the cheapest, most staple format of cheese you can buy is 8-ounce bars. Now, 20 years ago when I came to the country, 25 years ago when I came to the country, um, there were no shreds available at the grocery stores. So we used to have that, little grater, and you would take the cheese and grate it, and that's how we got shredded cheese. And there was a slicer. You use the slicer to make sliced cheese. So now, if I go to the grocery store and I don't have money, or I'm tight on my budget, my need for buying a shred goes down because I know I can come home and grate the 8-ounce bar because that's cheaper. So the decisions and the choices that the consumers will make, or are likely to make, I shouldn't say will, because that implies a level of certainty, will be to buy cheaper, more staple food groups that I can then use to feed more people at home.
Right.
What that will do is that will shift the buying from higher end, high frill, more functional, hence higher price per unit products to the staple products. So within the cheese group, I would say that, slices should sell more than shreds, and then 8-ounce bars should sell more than slices. And the dairy case should sell more than the deli case. Because people will move from higher price per unit to a lower price per unit, product groups within each categories as incomes get impacted. Now, what that definitely does then is keep the baseline price of cheese supported. It may not give us an additional lift. So what that entails is if we, I hate to do this, but we'll do it, is let's take, price levels. So is $1.20 cheese cheap? I'd argue that if $1.20 cheese is very cheap compared to the protein and the food value that a consumer would get. You could buy a bag of chips, or you can buy a block of cheese, or you can buy a cauliflower. And I think the choices will be between chips and cheese and not cauliflower. And I know nothing to pick on anybody. Cauliflower is an example that came to my head. What I'm trying to say is that cheese will fills the snacking category and food category really, really, really well from a consumer standpoint.
Okay.
And if you have limited budget, what would you buy, chips or cheese? I think you may buy chips the first 2 times. The third time you'll end up buying a block of cheese because you will realize that I only have this much money. How do I pack in more food? Then luxury, and then chips very, very quickly become luxury, and cheese doesn't become luxury. So hence, I feel that $1.20 cheese is is a fairly it is affordable and it's low. Now, does that mean it couldn't go lower? So 2008, 2009, we did see cheese go to 80, 90 cents a pound as well. Class 3 was $9 a hundredweight, so cheese roughly was 9.95, 98 cents a pound. But I think if cheese goes there, it stays there for a very small period of time. So I think cheese is supported. And I would say that, at $1.15, $1.10, Friday cheese, Thursday cheese traded at $1. I would say it's more constructive from this point from a price standpoint than downwards. Having said that, does the price have a chance of going from $1 to $1.80 in 2 months? Less likely. Can the cheese go to $1.20 and stay at $1.20 for 6 months? Possible. That is definitely a possibility. Can the cheese go to 60 cents and stay at 60 cents for 6 months? Knowing what I know today and understanding what I understand today, I think that is very unlikely. I think at $1.80, $1.10, $1.20 at these price levels, it is cheap. It is cheap, it's affordable, it's a good form of nutrition, and I think that continues. Butterfat. I think this summer will tell us a lot about butterfat in the sense as right now, as milk school programs are closed, not all the milk buying at the grocery stores is offsetting the milk consumption in school programs. So there's some level of surplus milk. More milk that goes into fluid processing. Not everybody drinks whole milk, right? So people drink skim milk, people drink fat-free milk. All of that increases the supply of cream in the marketplace. Cream, the best way to store cream is to make more butter from it and put it in large blocks and put it in the freezer. The challenge that the butter manufacturers are having, if they're not having, they will have likely shortly, is packaging. Because you can create bulk and put it in storage, but you need packaging to be able to convert that bulk butter into smaller packages that the retail consumers can buy. Right. So packaging notwithstanding, that excess butter that's getting created because there's excess or surplus cream in the marketplace becomes butter inventory. More inventory in the warehouse, bears heavy. So when there is a demand surge, we already have this massive reservoir of butter that can be deployed to meet that demand surge. So what that does is that rations the pace at which recovery on butterfat, might happen. Okay. Now, the things that positively change this picture significantly is international trade. Right? Now, one thing to make a distinction is that what is being restricted is travel, not trade. Humans can't travel borders. Doesn't mean products don't travel borders. Products travel borders, right? And countries have an incentive to keep trade open, because if they're not buying anything, they're not selling anything either. So if the port is open for them to ship things out, the port is open for them to receive things as well. There is a simulation that was done in October last year of the World Economic Forum did a simulation of a pandemic breakout, and it's a pretty long conversation. We'll keep it for that aside. What I remember from that very distinctly is a very senior government official from Australia basically said, we have fuel supply for only a month. So if we shut our borders, we'll run out of fuel. So we can't shut our borders, right? We'll have to keep the borders open for us to keep buying fuel from the world outside. So if trade is open, I think, that's what then keeps the demand side also moving. Maybe not in the same volumes that were being purchased previously, in reduced volumes, but they will move. Our biggest export market for food and cheese is Mexico. It's a very easy border because nothing has to get on ships and cargoes. It just goes across the border, transshipment, the container shows up, it gets put on another truck, and it moves. And Mexico doesn't have storage. And I mean that figuratively, is that why would a country like Mexico invest in having large storage capacity when the partner up north across the border has storage and can finance inventory in that storage without draining working capital in Mexico. So Mexico doesn't have capacity to store. They at some point, they will have to buy. Maybe they don't buy as much, but they buy. I think the markets that are more concerning at the moment from an international movement of cheese is concerned is Japan and Korea. For simple reason is those are the countries that were most impacted, at least in the recent past, with the COVID. So not only is the I'm less concerned with social distancing there as much as I'm concerned with losing demand altogether, or to a great extent, because there are people who, when people fall sick, they eat comfort food. And I don't know if cheese is the comfort food in Southeast Asia. It's probably something else. So there's probably some demand configuration. But so if no export happens, I think $10 is cheap. If exports happen, then $20 is cheap. And hence I feel that if the price goes down substantially, there's less likelihood of price staying there. But that doesn't mean the price gets put on fire and goes to $1.80, very quickly either. We might see $1.80s in the middle because of logistics issues. So certain markets don't get it, or milk got dumped too much last month, not enough cheese got made, or labor not being able to show up at a plant and the plant doesn't operate. Instead of operating, 3 times 6, 18 shifts a week, now they're operating, let's say, 12 shifts a week. Well, that much less commodity production.
Yeah.
So that's my, construction of, is this the bottom? Well, I would say this is as close to bottom as it can get.
Okay.
Right? Can the price go lower for very short durations? Yes. Can the price go up and stay at a mediocre level for a longer time? I think that's probably the most likely outcome. That let's say class 3 milk becomes $14 and stays at 14 for 6 months. Is very likely. Class 3 jumping back to $20, unlikely, unless not because of supply, then it's because of the plant thing.
Right.
Can butter go to $1 and stay at $1 for 9, 10, 12 months? I have to entertain that's a very, very, very high possibility, given the amount of cream that's going into the butter churn to get made butter and being put in cold storage. And we have seen this playbook a little bit, in the past in Europe with the intervention. Think of Europe as, this pandemic did not happen, but from a losing demand is concerned, it's a very similar situation. So Russia in 2014 said, we're not buying anything from Europe. Well, Europe just lost a huge demand market. So the demand suddenly overnight fell from whatever it was by 20, 30%. Well, similar demand shock as we are dealing with now, right? And so that butter and skim went into intervention, and it took 3-4 years for the price to then break loose, because every time the price would go up, you could supply it from the stock sitting in storage.
Yeah.
So, right? It's sitting there. I think, that's my problem as I'm thinking through butter, is what could solve the butter problem. And until, we don't have solutions or outlets for this butter to move, then the butter sits. And the butter sits, it keeps a ration on the price. Now, in the past, countries like Morocco and some of these, lesser financially endowed countries, any price below $1.50, they would buy U.S. butterfat. But we do have a problem with financing trade at the moment as well. So it's not just a demand supply shock problem. There's also a liquidity cash problem in the marketplace.
Right.
Does that address what you were thinking?
Yeah, it does. It kind of tells us how it's going to end. So my next question to that is, what would you recommend that farms be looking at doing, dairy farms specifically, right now, let's say 6 months from now and about a year from now? We'll do those 3 markers. So we'll start with right now, based on what's going on, what are kind of the steps that you would want to see farms taking?
Yeah. So I think irrespective of what situation we're in, cost management, is probably the top of the list.
Right. What we have control over right now.
Right.
Okay.
Cost management and efficiency. Now, and I've heard different, very encouraging stories from people I work with and people I don't work with, anecdotally, is what are farms doing to manage that efficiency. A dear friend of mine and my client, they are looking at how do they take surplus milk and cycle that back as a part of the feed for the cows. I think that's a fascinating fact. More people should be thinking about things like these. So we are not taking the economic, impact. We're minimizing. We're not eliminating. We're minimizing the economic impact of dumping milk.
Absolutely. You're never
Right?
going to replace that cost total, but the cost savings, even if there's still 25% of the lost value, it's better than nothing for sure.
Absolutely. So like that's one thing I've heard very promising, very tangible, right?
Right.
Similarly, what I've heard from out west is farmers reducing number of milkings. So in very efficient farms, people were doing 5 milkings every 2 days. So farmers have looking at reducing from 5 to 4 milkings in 2 days rather than 5 milkings in 2 days, or you know 2 milkings a day from 6 or 5 every 2 days, right?
Right.
And that's putting a little lower pressure on milk production. Just using the natural cycles to curtail whatever little, and everybody curtailed. I would say 0.5%, 1%, 2% here and there. It all adds up, right? It just adds up, and these are things that people can do on the farm without. Well, I don't live on the farm, so I don't know these things. That's why I'm not allowed in the farm in my own home. Uh, Stay away. But so measures like those, right? Also, then the third part is how do you use feed rations to manage down production without necessarily impacting the health of the herd.
Right.
Right? There
Instead of
is
taking the reducing milkings approach, how do I make each cow produce less, not from a lack of milkings, but from an actual throughput standpoint?
absolutely without necessarily impacting the health of the herd,
Yep.
because at some point there will be demand, right? I mean, because as we were arguing last time, is that I don't think the number of mouths to feed are reducing net,
Right.
right? If the death toll from COVID is increasing, I think the death toll from casual death, which are people running over other things, that's reducing as well, right? So the number of mouth feeds, so there is demand. Demand is going to show up, um, and when demand does show up and the price is high, if you don't have herd at that time to deploy as a response to that increase in demand,
Yep.
that's a huge opportunity cost, right?
Yes.
So I think so. Those are the most immediate ones, right? How do you look at tools at disposal on the farm and deploy those tools from a production standpoint?
Yep.
The second thing is the financial markets, from a risk management is concerned. Um, Even in the worst possible times, do offer the ability to manage risk. Volatility in prices. So in the last, let's say, 20 trading days in the marketplace, milk price class 3 has gone from 16 to 11.50 to 16.50 to 14. So what this volatility allows you to do is take advantage. You can't take advantage and make out like bandits, but you can at least deploy certain measures that allow you some peace of mind on the revenue that you will make on the farm.
So this is a really interesting point that you're making here, and I just want to make sure I reiterate it so that I'm getting it, and hopefully all of our listeners are getting it too, that even though usually we view volatility as bad, I mean, the connotation is in general negative. What you're pointing out is from a risk management standpoint, realistically, if you can make milk for $16 and there's a swing on a day that it goes above 16, even though it's novel, right? It's not going to stay there. You could lock in a percentage of milk and know that, okay, well, I'm at least going to break even, pay my debt, gain equity, do whatever I need to do. So that's a really interesting way to look at volatility instead of the way we usually see it as, oh, it's bad, it's bad, it's bad.
Absolutely. I'll give an example that for one of our clients, last week or actually this week, I forget, it's all a blur. One of these Mondays
Yeah.
and Tuesdays, whenever we had volatility, um, we were able to get that farm, almost 100% hedged, um,
Wow.
because of the swing that happened. Now, the farm did the bulk of the hard work of making a decision and coming up with what was their no regret price, or the price of milk that would keep them out of financial difficulty. Um, and you're giving up some value, absolutely, but the opportunity cost of not doing it is high. And what I'm saying is that the volatility will give us opportunity. Volatility will give us, whenever there's volatility, there's opportunity for us to secure our downside, and that requires the farm to work with their bankers, understand how much room they have, and then work with their advisors or whoever's helping them out with,
Yeah.
and have some of these plan and response decisions in place, so when there is an opportunity, then those measures can be deployed. And
Okay.
these need to be thought and done in short and midterm. What I mean by short is, so what can one do? Today is April 10th. What can one do for June and July price? That's pretty front and center, right?
Right.
Second element is, so how can one think about milk price second half for this year,
Yes.
right? And the third one is, how do you think about milk price second half this year, first half next year? So
Right.
you put in these three different layers, and the way to think about that also is what we call, or what I've been trained to call, is clip size. So clip size in the sense is, do I hedge 100%, or do I hedge 10%, or do I hedge 20%? Maybe I hedge heavier in the front. So June, July, maybe I should hedge 70% and hedge 20% next year, set first half, because I don't know, but
Right.
at least some certainty. And as the picture becomes clear, you can add to it.
Yep.
Um, because, I mean, and then also apply what we know today about demand destruction, right?
Yep.
The likelihood of the destroyed demand materially changing over the course of the next 6 to 8 weeks is unlikely. The likelihood of demand improving in the course of the next 6 months is higher. The likelihood is higher.
Okay.
The
Yeah.
likelihood of demand returning to where it was in 24 months is extremely high. Right? That's human spirit has to come back to that level. May not come back tomorrow, but it'll come back in 2 years. Now, those are likelihoods, but we have a business to run. We have cows. We have bills to pay.
Those are
So that,
true.
yeah. So hence, this thinking has to be done in that period. So that's the real short term. Like, what do you do every week and every day? I think cost management, and looking at markets and seeing what can you do to secure some floor levels, even though the numbers may not look very promising. I think having a assurance that your revenue will not go down below $14 is much better than 10,
Right.
right?
Oh, absolutely. I would agree completely. And that's great. You've really addressed actually all three time categories just with that answer of, looking at what we would say is immediate, even within the next 1 to 2 months, and then really 6 months out, and then into the first part of next year. So my next kind of question, and we've talked
One
about,
thing,
oh,
one thing to add to that is, there's a difficult thing to be done as well. And the difficult thing to be done as well is, please have as many conversations as you need to with your financiers,
mm,
right? Um, those discussions may be extremely uncomfortable and unpleasant, but you rather have them now and have time to prepare for whatever it is that you need to prepare for,
yes.
than to have it, when there is, right now it's a risk. When it happens, it becomes a problem and not a risk anymore.
This feels like the justification to have a prenup. Same thing, right?
But the point is that, have those discussions, because in one of my previous lives, one somebody explained to me that the sooner you are late, the more time you have to catch up,
That's true. That's a good way
right?
to put it.
Yeah, so the sooner you know what it is that your financier will need of you if certain things happen, the more time we have to prepare for it, the more time we have to prepare for it, the less expensive it is to prepare.
Right.
If you have to buy flood insurance 2 days before the massive rain forecast, it's expensive,
Yes.
right?
Yes.
When we know there's a high likelihood, but it's not rained yet, we may still be able to get it done.
Right.
So please, in the immediate term, for actions to plan for the mid and long term is to have discussions with the financiers and understand what options you have and what the cost of that is. So that can be factored into your cost management.
As well.
And in cost management, fuel is not cheap, but it's cheap. I think your suppliers will not give you the price that you see on the screen because they are making you a market based on what is sitting in their tanks. But work with them as well. Work with the electricity providers. Work with every line item and cost that you probably have not worked in the past, and see what you can squeeze out. You'd be amazed how many opportunities there exist.
Right.
And Kelsey, through you, anybody who wants to reach out to understand fuel, electricity, diesel, very happy to consult and help.
Cool.
And at least point them to the right directions on, hey, here's how you can do things like that. I think cost and these other things we talked about is what on the farm we should be doing.
Right. And I think too, I would only add to that, in those conversations with the financiers, as you evaluate each of your costs that you have management control over today, the important bigger picture then is to see where your decision points are, right? And I know we've talked about this a little bit from the perspective of where is my push-pull point of, even if I do all of these things and let's say markets still fluctuate beyond a point that I can continue to be profitable, even with all of these things, when do I need to consider a different option, and whether or not that means exiting dairy for a period of time, contracting the herd, or making maybe a bigger structural change. We need to know where that line is. So now is a good time, while you're already going in and evaluating all your costs and all these other things anyways at your break-even point, talking to your financier to say, okay, what is our kind of our bang point that we need to do something bigger than just these management changes.
Absolutely.
And you're right, having those kinds of candid conversations now, while uncomfortable now, are much better than if you're in the middle of it, to
Absolutely.
do it in advance of that. So that's great advice for sure.
And I left out the obvious feed. The feed prices. Anything, like I said, any line item on your cost that moves, there's probably a way to handle it. There's probably a way to squeeze out something more from it.
Absolutely. Thank you so much for joining us today, Anup. We really look forward to speaking with you again soon. As a reminder to all of you out there listening, we will be having these discussions weekly to cover topics about the market as they emerge. These times are changing really quickly, so we expect the topics to be very diverse from week to week. Be sure to check back with us.
Thank you for having me. Have a good day.